Well, what is going on out there today, guys? So this is going to be one of those videos where the algorithm will probably crush the video because it doesn't say, this stock is going to 10x or shocking news or any of that other stuff like that. So if you guys could just hit that like button right now, it's the only way videos like this get put out to the rest of the people out there. You probably missed my last value-packed educational video, as it was the worst video in like my last 50 videos or something like that because the algorithm pushed it to absolutely no one. And don't forget to subscribe if you like the truth without the hype and BS and all that other garbage that is out there in the YouTube world. So no messing around today, get your notepad ready and let's dive into this. So first, there are 3 things you must understand to properly value a stock before we even get into the mechanics of doing the work in the first place. So don't cheat and skip ahead. These 3 things will help it all make a lot more sense in the end. So the first thing you must understand is there's more than one way to value a stock. Some people like to look at discounted cash flows, some people like to look at PE ratios, some people like to look at forward PE ratios, and some people just like to listen to YouTubers. Which, despite me doing this, I do not suggest listening to YouTubers at all. Your risk tolerance, goals, and all that good stuff is not the same as mine or a random analyst or anyone else out there. You have to find what works best for you, and I have no problem if you want to use discounted cash flows, and I prefer forward PE to value a stock. The important thing is that you are doing a valuation properly, which we will walk through that today, but there is so much more to it than that, and that's what leads me to my second point. And that is, there is more to valuing a stock than just what we will discuss here today. Now, whoa, slow down, don't worry about it. You will be able to apply everything we talk about today immediately in your investing, and you will be able to create a valuation for a stock. But just know that nobody can cover every possible scenario or question in a single video. I thought my course in the private group covered it all completely, but I was wrong obviously, and I have made several other videos addressing some great questions about valuations that have come up, and it seems like every other live Q&A that we do, more great questions come up about valuations, and so we discuss those as well. I seriously could make an hour-long video, and I still don't think I would get all the answers to all the questions. And nobody wants to hear me talk for an hour. Nobody. And the third thing is valuations are an art more than a science. There is no magic formula you can just plug in the numbers and it can tell you if it's overvalued or undervalued. Maybe back in the 1920s when every stock was considered fairly valued at a PE ratio of like 10 or something like that, that may have been true. Actually, it wouldn't have been true because they didn't even have computers back then to do that, so they would have to like manually do the formula or whatever. But those rules slowly went away, and by the 80s with the derivatives market and the debt markets and the rise of tech and the willingness to pay higher multiples overall, those rules pretty much did not apply at all anymore. Bottom line, there is no magic formula or calculator. You have to put in the work. So as alluded to earlier, I typically use forward PE to determine a value of a stock. Now why I favor forward PE is because I am usually buying growth plays, and in my opinion with growth plays, what matters most is not what happened last quarter, last year, 3 years ago, but what is going to happen in the future. So a forward PE ratio is future looking, and most of our favorite stocks are forward looking companies. Now yes, I absolutely use other methods when looking at other types of stocks, but for the stocks that we discuss the most on this channel, I typically use forward PE. Forward PE measures a stock's current share price relative to its earnings per share or EPS. PE ratios are also sometimes known as the price multiple or the earnings multiple in case you hear those terms thrown around. So before even determining a forward PE, I like to pull the past PEs to kind of get a gauge for how this stock normally trades. And if possible, also do the same for competitors, as that can be helpful as well in defining a value, but at a minimum you need to know the past numbers for your stock. The next step is use this simple formula to determine the forward PE. You just take the share price now and divide it by the expected EPS or the forward EPS or whatever you want to call it, and you can basically find those with just a simple Google search. Google search. If I could speak today, I'd say Google search. This shows me the price of the stock relative to what the expectations are of the future earnings. Or to put it another way, how good it's going to do in the future compared to the price right now. So if that forward PE is low relative to its past PE, then you know it's priced pretty decently compared to how it's expected to perform. Now keep in mind these expectations are just analyst estimates in the end, so they could be wrong and they will change every quarter as new guidance is given by the company. Also keep in mind, if you feel there is something that is really going to drive growth beyond what the estimates are, then it may make the price more attractive than what the average investor can see by looking at these analyst estimates. But I already know what you're thinking. A lot of our favorite stocks lose money and have no earnings, so what the heck do you do now? Well, don't worry about it at all. The fix is actually quite simple. Companies that have no earnings or that are losing money do not have a forward PE ratio, since there is nothing to put in the denominator or the bottom of the equation, so you would just use the price to sales ratio instead. The formula is exactly the same, just replace earnings with the sales. Now there is one giant problem with all of this, and that is that many of the growth stocks that we love do not have any real history in the first place to make an accurate assessment on if it's overvalued or undervalued. How do I know what a good PE ratio for a stock is if they have not had their first earnings call yet or only have 1 or 2 earnings calls under their belt? The honest answer is you don't. That is why newer stocks are considered risky, because you really don't know what the market will pay for that stock. The market is basically still trying to sort that out. And to illustrate how hard this is, even for the pros, how many projections for IPOs are ever right? And I mean anyone's projections, either to the upside or the downside or whatever. The answer is very few are right, and nobody is right with any amount of consistency. This is why I stay away from them altogether and let the dust settle so I can do a better valuation on the stock. Otherwise, I'm just strictly guessing like everyone else is, and even the pros guess very poorly. So the more quarters they have under their belt, the easier it is to determine a valuation. But unfortunately, the stocks that get newer investors excited and into investing in the first place are also typically the hardest stocks to value. So now it turns into a scenario where you are asking someone with no real experience or know-how to try and project the valuation on something that is very hard for even experienced investors to project. Which of course leads some to get information from hype channels who tell you every stock is going to the moon and, look at this chart with basically a vertical line, and before you know it, you own Lucid at 65 or Bingo at 16 or a bunch of other stocks at all-time highs that have now fallen 50%, 70% or more in some cases. I talk to people daily who, instead of enjoying investing, are agonizing over if they should cut their losses, or they did cut their losses and think investing is just not for them. I don't want any of you to ever be in that situation. The good news is, the more valuations you do, the easier it gets. Sure, your first few are going to be rough, but it's okay to do valuations on companies you don't intend to buy just to practice. And I actually recommend that. I mean, seriously, pick an easy stock like Apple or even Walmart or something like that. Something with lots of historical data so you kind of get a feel for what happened to the stock at each point in the past, and you will start to see when it's overvalued or undervalued. Then you will feel much more comfortable jumping in and starting to do valuations on some of the high-flying growth stocks that we all love. And before you know it, it will be much easier to answer the question of if a company is overvalued or undervalued. And if you want more information on valuing a stock and a great support system to help you on that journey, there is a course and multiple videos and a great group of people, including myself, ready to help you in the Market Insiders private group, along with a course on creating an infinite money loop, and other courses are available as well, along with live weekly Q&As where you can ask me anything, a great Discord group, tons of exclusive videos, downloads, and more, all for the price of a meal for 2 at McDonald's. Consider it a cheap date that went really well. So check that out. It's the first link in the description and the pinned comment. So thanks for watching, and we'll see you in the next one.